The trap has been set. For years, major banks have been playing a dangerous game in the silver market, building massive short positions, betting billions that silver prices would stay low or fall. And now, the walls are closing in. According to recent regulatory data and analyst observations, several major financial institutions appear to be sitting on silver short positions so large that covering them could trigger a squeeze unlike anything we've seen in decades. They can't buy without spiking the price against themselves. They can't hold without bleeding losses. They can't exit without revealing the size of the problem. They're trapped. And here's what's hidden. The mainstream financial media isn't covering this. The banks aren't discussing it in earnings calls. The regulators aren't raising alarms. But the data tells a different story. A story of positions too big to close, of losses mounting daily, of a crisis brewing behind closed doors. Welcome to Hidden Wealth. Today, I'm exposing how major banks got trapped in silver, why they can't escape, and what happens next when the squeeze finally hits. This is the crisis hiding in plain sight. To understand the trap, you need to understand how banks got into this position. For decades, major banks have acted as market makers in silver. They facilitate trades, they provide liquidity, they take positions to manage risk. But somewhere along the way, their positions appear to have grown beyond risk management into something else entirely. According to data from the Office of the Comptroller of the Currency, a small number of U.S. banks hold concentrated derivative positions in precious metals worth hundreds of billions of dollars in notional value. The exact breakdown between gold and silver isn't fully transparent, but analyst observations suggest silver positions are substantial, primarily on the short side. Why would banks short silver so heavily? Several possible reasons. First, suppressing prices benefits certain interests. Lower silver prices mean cheaper industrial input costs. They mean less competition for paper currencies. They mean controlled inflation metrics. Second, shorting was profitable for years. When prices fell, shorts made money. The strategy worked, so positions grew larger. Third, momentum built on momentum. As short positions grew, banks had incentive to keep prices low. Rising prices meant losses, so they added more shorts to push prices back down. This worked brilliantly until it didn't. One commenter captured the dynamic perfectly. He wrote, quote, "Banks hold paper, not real silver, and the global bank has created new rules for the banks so that if they hold paper silver, they are punished. So they are scrambling to get real silver to back up their paper." The rule changes he's referring to involve Basel III banking regulations and similar frameworks that treat physical precious metals differently than paper derivatives. Suddenly, the paper positions that were profitable for decades became potential liabilities. And here's where the trap closes. These positions are reportedly so large that closing them would require buying massive quantities of silver. But buying massive quantities would spike prices, which would increase losses on remaining short positions. The more they try to escape, the worse it gets. That's the trap. That's what's hidden behind the complex financial engineering. The trapped banks face pressure from three directions simultaneously. Each wall closing in makes the other walls more dangerous. Wall 1. Physical demand explosion. The first wall is surging physical demand that's draining available supply. Industrial demand for silver has been rising steadily. Solar panels now consume over 150 million ounces annually, and that number grows every year. Electronics, medical devices, and electric vehicles all require silver. But here's what's changed recently. Retail investment demand has exploded through unexpected channels. Costco, the warehouse retailer, reportedly now moves approximately 20 million ounces of silver per year. That's 2.5% of global mine production through one store chain. This demand didn't exist 3 years ago. Meanwhile, major producing nations appear to be restricting exports. China and Mexico, representing roughly 30% of global production, have reportedly halted or limited silver exports. Every ounce absorbed by industrial users, retail investors, or national reserves is an ounce unavailable to deliver against short positions. The banks need physical silver to close their shorts, but physical silver is increasingly spoken for. Wall 2. Price gap. Divergence. The second wall is that growing divergence between paper and physical prices. In Shanghai, silver recently traded at approximately $102 per ounce. In New York, COMEX silver traded at approximately $89 per ounce. That's a $13 gap between markets. Normally, arbitrage would close such gaps. Traders would buy cheap in New York and sell expensive in Shanghai until prices converged. But when export restrictions prevent physical flow, arbitrage becomes impossible. The gap persists. This gap is devastating for short sellers. They're short at prices based on COMEX levels. But if they need to acquire physical silver to deliver, they might face Shanghai pricing. The losses compound. The divergence is the market screaming that paper prices and physical reality have disconnected, and banks with paper shorts are on the wrong side of that disconnection. Wall 3. Regulatory pressure. The third wall is changing regulatory treatment of precious metals positions. Basel III and similar banking frameworks have altered how banks must account for precious metals. Physical gold and silver receive more favorable treatment than paper derivatives. This creates incentive to convert paper positions to physical holdings, but converting short positions means buying silver, which raises prices, which triggers losses. Additionally, scrutiny of commodity market manipulation has intensified. JP Morgan paid $920 million in 2020 to settle charges of precious metals manipulation spanning years. Traders faced criminal charges. Banks with concentrated short positions now face both regulatory pressure to reduce those positions and legal risk if their trading practices are examined too closely. The combination creates a compliance squeeze on top of the market squeeze. How the walls interact. These three pressures reinforce each other in a dangerous feedback loop. Physical demand drains supply, widening the paper-physical gap. The widening gap increases pressure on shorts. Regulatory requirements force position reduction. Position reduction requires buying. Buying further drains supply. Each wall pushes banks toward the other walls. There's no escape direction that doesn't lead to another problem. One commenter described the endgame bluntly. He wrote, quote, "Hold physical and wait until 3-digit, coming fast. Do not give chance for short to cover." Whether that specific prediction proves accurate, the underlying logic is sound. If physical supply is constrained while shorts must eventually cover, prices have one logical direction. The banks appear to be trapped in exactly this dynamic. Let me show you specific evidence of the squeeze pressure building. Evidence 1, COMEX inventory. Decline registered silver inventory at COMEX, the metal actually available for delivery, has fallen dramatically over the past 2 years. At various points, registered inventory has dropped to levels that represent only a small fraction of open interest, meaning there are far more paper claims than physical metal available. This is mathematical squeeze setup, not enough chairs when the music stops. Evidence 2, delivery requests, rising. The percentage of futures contracts standing for physical delivery has reportedly been rising above historical averages. When more participants demand actual metal rather than cash settlement, it drains the already depleted inventory faster. Each delivery request tightens the squeeze on remaining shorts. Evidence 3, premium persistence. Physical silver products continue trading at elevated premiums above spot price. This premium persistence suggests physical demand exceeds readily available supply. In normal markets, premiums attract supply and compress back down. Persistent premiums indicate structural imbalance. Evidence 4, concentrated positions. Regulatory data shows that silver derivative positions remain concentrated among a small number of large institutions. This concentration means that any squeeze affects specific entities intensely rather than dispersing across many players. Concentration creates vulnerability. What the evidence suggests. Collectively, this evidence paints a picture of a market under stress. Inventory falling, delivery demands rising, premiums persisting, positions concentrated. These are the conditions that historically precede major price dislocations. Whether that dislocation happens tomorrow or next year, the structural setup appears clear. The banks appear to be sitting on positions they cannot easily exit in a market that's tightening around them. If the squeeze intensifies, several scenarios could unfold. Scenario 1, controlled retreat. Banks gradually reduce positions over months, accepting losses but avoiding catastrophic moves. Prices rise steadily but not explosively. This is their best case outcome. Whether conditions allow this controlled exit remains uncertain. Scenario 2, forced liquidation. A triggering event forces rapid position closure, perhaps a major delivery demand they can't meet, perhaps regulatory action, perhaps a counterparty failure. Forced liquidation means buying at any price. Prices spike dramatically, losses multiply. Scenario 3, rule changes. Exchanges or regulators intervene to change rules mid-crisis, cash settlement mandates, position limits, trading halts. This protects banks, but destroys market credibility. We've seen similar interventions in other commodity squeezes. Scenario 4, physical default. The ultimate scenario. Shorts cannot deliver physical silver and cannot source it at any price. Contracts default. Paper market seizes. This scenario seems extreme but becomes possible if physical supply truly cannot meet obligations. What I expect some combination of these scenarios. Banks will attempt controlled retreat. Conditions may force faster exits. Authorities may intervene to prevent worst outcomes. Physical paper divergence will likely widen regardless. The exact path is unpredictable, but the direction seems clear. Physical holders appear positioned for outcomes that paper holders may not survive intact. For balanced analysis, let me present alternative views. Alternative 1. Banks have hedges. Major banks employ sophisticated risk management. Their short positions may be hedged through other instruments. Net exposure might be smaller than gross positions suggest. Alternative 2, central bank support. If major banks face crisis, central banks may provide support, emergency lending. Position absorption. The too big to fail doctrine may extend to commodity positions. Alternative 3, demand could slow economic recession, could reduce industrial silver demand. Investment enthusiasm could fade. Conditions creating the squeeze could reverse. Alternative 4, supply could increase. Higher prices incentivize more mining. Recycling increases. Supply eventually responds to price signals. My assessment. These alternatives deserve consideration. Banks are sophisticated. Support mechanisms exist. Markets adapt. However, the structural position appears genuinely precarious. Hedges have limits. Support has costs. Demand trends appear structural, not cyclical. The squeeze may be slower than bulls hope, but more significant than bears expect. Let me bring together what's hidden here. Major banks appear to be trapped in silver short positions accumulated over years. Three walls are closing simultaneously. Physical demand is draining supply. Paper physical price gaps are widening. Regulatory pressure is forcing position adjustments. The escape routes are narrowing. Buying to cover raises prices against them. Holding bleeds losses. Rule changes may protect them, but destroy market credibility. What happens next depends on factors no one fully controls. But the setup favors those holding physical metal over those holding paper claims. The crisis isn't visible on financial news networks. It's hiding in regulatory filings, warehouse reports, and market microstructure. But the data tells the story clearly. The trap has been set. The walls are closing. Something has to give. If this revealed what's hidden, subscribe to Hidden Wealth. I expose the crises that mainstream media ignores. Drop a comment. Do you think banks can escape this squeeze? What's your prediction for what happens next? Thanks for watching. Educational content, not financial advice. Keep looking for what's hidden.